Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hey, I'm Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. Before we get going, a little favour from me, please. I never ask for these things, and I've been told by our podcast people that I need to start asking for these things. Reviews on Spotify or Apple Podcasts or wherever you're tuning into this, they reckon that they get a real kick out of seeing the great feedback coming in, 5 stars if you think that's what we're due. We don't ask for a lot here at Smart Property Investment. If you can do that for me, that'll make my job easier because it means less people are going to be asking me for it. But no, we do appreciate that the feedback, the commentary. Let us know what you'd like us to do and talk about, and we'll keep improving this podcast channel and the wider Property Investment Podcast Network as a result of it. But today, here we are, getting ready. So everyone's strapped in for potential interest rate cuts. I was looking at the boom or bust report out of SQM the other day, and they reckon the base sort of setting or framework they've approached it is 2 interest rate cuts, between 25 and 50 basis points cuts, mid-year, 500,000 population coming in, and I think the weighted average across Australian capital cities is somewhere between 1 to 6% growth. I think Perth, Adelaide and Brisbane would be showing growth. Melbourne and Sydney would be going backwards. So that's where we are. Whether or not that represents a normal market, probably. I think the average sort of compounding annual growth for property in Australia historically is about 6.5%. So maybe that is normal, but I know most property investors don't like normal. They try and get extraordinary normal. And typically they lean on people from across the spectrum to help them out with that, mortgage brokers, financial planners, their accountant, but also buyer's agents. One of the buyer's agents we turn to is Atlas Property. Lachlan Vidler is joining me in the studio. I'm going to ask him about all this sort of stuff. Have you left a review yet on Smart Property Investment? Probably not.
No, I have. I've given it 5 stars.
What about everyone else in your team?
Nah, definitely not. It's hard enough to get them to do the work that they need to do and do their admin
not the important. So it's not admin.
It's I tell them to fill in the details on something, and it's like pulling teeth sometimes.
Happen. Yeah, it's fun, isn't it? Technology does everything, but it doesn't do anything at all. It still comes back to the human pressing a button. How you been?
Good.
I haven't seen you yet this year.
No, we're only a little bit into it though.
I know. It feels like we're all the way through, but it's still summer. Yeah. School only just went back. It feels like it's been back for a while, but school's only just gone back.
Yeah, it's we had a big company-wide meeting this morning with my whole team, and we were just talking, saying like we're halfway through Feb, basically. It's
what are we doing?
Yeah, before you know it, blink and Q1's done, and then we're into the mid-year, and then suddenly everyone's getting tired because it's the back half of the year, and that's another year done. It's blink twice and it's over.
Yeah, it's the way it is. You just go fast. So what did you do over the break? Did you do anything exciting?
I went away. I went away with my partner and her family, which was a lot of fun. We went over to America. So we did about 3 weeks.
So
there.
Were you there when the inauguration was on?
Left just beforehand. We left the day that the bushfires kicked off in LA. So we actually we drove from Vegas back to LA, and it was very strange because we were driving. So obviously none of us were on our phones. We were just enjoying the trip and everything. And it was so windy driving there. And I've done that drive a few times, and I remember there's a little bit of wind because you're sort of going through the desert and that sort of thing, and you can whip up a bit of wind. But I don't know, it just felt a bit eerie, a bit different, and like the car was getting thrown all over the road. And we got into LA and we drove straight to the airport. We literally made the check-in for the flight by 10 minutes.
Okay.
We were late.
The problem with dropping your car off at LAX, you always got to drop it off in some dodgy place down, what's the boulevard through there? Boulevard.
Yeah.
And you always wait around, you're sitting there going, I'm going to be late for my plane, and then you wait for the bus to take you back to the terminal.
I had never done that before. I'd always driven in, but then I might stay a night or two in LA, but this time it was literally drive and drop off. So I'd never done that, and we were packed.
And you're just around the corner, but you're sitting there going, oh God,
literally
I'm waiting around and this, that and the other. Yeah.
Oh mate, it was insane. But yeah, anyway, as we're driving, I remember looking out the window and I thought, oh, I can see like an orange tinge, but it was sort of around some industrial areas. I thought, how you drive through industrial areas and you just see weird colours or smoke, or maybe the sun's a bit, anyway. And I didn't think much of it. But then when we flew out, I've done a lot of flying. I've done that route, LA to Sydney, a number of times. My partner used to be a flight attendant. She used to do that route, and we were there, and we both said that is the worst turbulence we've ever had in our life. Yeah. It was like. It was
out of LAX.
Out of LAX, and it was because it was the bushfires day. So the wind, I think that I read a news report the next day. I think they said that it was gusting at times up to 200k an hour.
Yeah. That would have been bumpy.
It was like, genuinely, it was a little bit.
So even your partner went, oh,
yeah,
God, that's bad.
Yeah, she was like, oh, like this is.
When flight attendants sort of start getting a bit nervous around.
It was pretty rough. Yeah. So
who'd you fly with?
Spirit of Australia.
Oh yeah, good.
Yeah,
front of the plane, no doubt. You
not
fancy
quite,
people,
not quite, but
halfway up the front.
Yeah, we're halfway up the front. No, we were actually going to fly staff, but my priority, because I'm not, it was going under her dad's benefits because her dad worked for Qantas as well. My priority was a lot lower, and then there was a point seat left in economy, so I booked it for my partner and I, and then we managed to jag and upgrade to premium economy.
There you go, living the dream.
Yes, the bumpy dream as it was, but
wouldn't have been bumpy for long, right? Or was it?
Oh man, it was like half an hour, and when you're getting thrown,
because it would have been the wind would have been behind, because the wind was coming in from the west, wasn't it?
Oh, I don't remember.
Yeah,
I don't remember.
I think it was a westerly wind, so it would have been blowing back out over the Pacific. So
it was about 30 minutes of it, and then you know it's bad when the
beverage service.
No, and the captain comes over, he turns it off, and he comes over to the PA and he says, "All right, guys, I've turned it off, but in 30 minutes you're gonna have to strap back in." And
God.
It's not the most like comfortable, I think, experience when you're sitting there and you got 30 minutes of notice of you're going to strap back in. I'm pretty sure that was almost his exact words.
Yeah. Turbulence is, I know, maybe it's a metaphor around property, but turbulence, here we go. Metaphor on property, here we go. See, turbulence, they'll tell you there's nothing to really be concerned about, right? It's just part and parcel of flying. It doesn't mean the wings are going to fall off. It's natural for different sort of air pockets to be doing different things, and therefore you bounce around. And there's nothing you can do about it.
Yeah,
you just got to strap in and push through it, knowing that yes, it's distractive. Yes, it's quite discerning. Yes, you can't control it, but you should get beyond it at some point. You can go up, you can go down, you can go left or right. You can get away from turbulence. You know the plane ahead of you, 30 minutes ahead, has just gone through that, and they've wired back to the other bloke saying it's a real turbulent pocket over here. Maybe you need to avoid it, maybe you need to go around it, or you just go through it.
Yeah,
that's what we're doing in property markets at the moment. There's a lot of turbulence. There's a lot of turbulence out there.
Well, I think the best way to deal with turbulence on a plane and turbulence in the property market is grab a beer and sit back and know there's nothing you can do about it, but it's going to be over in a few minutes.
Yeah. Strap in.
Push
through.
And it's going to be done before you know it.
Yeah.
It's before you know it.
And aviation meets property.
And most importantly, when aviation meets property, turbulence is perfectly normal and safe, same as a property market.
Yeah. You know? Absolutely is. You don't want it all the time. I don't necessarily like turbulence.
Smooth skies.
Yeah. I've had some horrible turbulent flights with some airliners which are a bit sort of dodgy. Yeah, it's very, very different. Very different when you're in a
Jetstar.
No, I'm talking about old Russian planes. Yeah, it's it's different sort of turbulence. That's when you start thinking that wings might fall off.
Yeah.
But how turbulent is the property market, Lachlan?
How turbulent?
And turbulence is good sometimes.
Turbulence is good because the thing is that turbulence means there's wind, and sometimes wind can push you a little faster. True. All right. To be honest, I would say that I don't actually think there's a lot of turbulence at the moment. I think from what I see, we're going to talk about today why waiting for the perfect time can really cost you significant hundreds of thousands of dollars. But I think that in terms of turbulence, there's no such thing as a perfect time to buy. And media, at the end of the day, is paid to sell clicks and newspapers and things like that.
Take that back.
Sorry, I take that back from Momentum Media.
Certain aspects of the media.
But
that media don't know what they're talking about.
And
here
that's
at Property Investment, we know what we're talking about.
Mainstream. The mainstream media.
Does that really exist anymore?
Well, but it's eyeballs, right? Do you go and pick the one area that's done really poorly for a very logical reason that you know is a good headline, or do you pick the other 85, 90% that have done exactly what you'd expect and have a very boring headline.
Yeah.
You know, it's so yeah, I would say there's not much turbulence. I would say, man, like we are getting some crazy valuations on properties that we have bought. And I don't mean crazy in the sense of there's no way it's real. I mean, we 100% know that they're real and why it's there, but just insane to see people who didn't try to wait for, you know, in inverted commas, the perfect time, jumped in when they could jump in. Man, like,
yeah,
wild.
It's a really important point, and I've sort of been a proponent of this through my sort of journey investing in property. You buy property when you can buy property rather than waiting for the right time to buy, because you know what, you'll always find the right place to buy when it's time for you to buy property. There's always somewhere that's worth buying. But I know, and this is what my people are telling me inside of your office, a debate that's going on, and maybe we can use this as a sort of a case study for having a good discussion around when is the perfect time to buy, and what is the real cost of waiting if you wait too long. You know, how the market rewards action takers rather than procrastinators. And from what I understand, you guys are debating, and it's a bit of a hypothetical what if, right? So tell me if I got this wrong, but you can only buy one more property because you've hit your serviceability thresholds.
Yeah.
And that's not probably going to change too much in the years ahead. So you're ready to buy now. So do you buy today and this is assuming that you cannot buy another property?
Yeah.
You know,
let's say 3, 4, 5 years. You know,
3, 4, 5
you got a
years.
good chunk of time ahead.
Call it 3, 4, 5 years.
Yeah.
Do you buy a property today in a location which is not yet seeing growth? However, when growth does happen, it should be accelerated. Versus, do you put that money in a high growth location now where the growth may have run its course and it's going to stagnate for the years ahead?
Yeah.
And you can look at that maybe with within the context of do you buy in Perth today because you might get immediate upside growth? I talk about that boom or bust report out of SQM, which I think, can't remember the numbers, but it's predicting ongoing growth. Or do you invest in Melbourne where it's got negative growth?
Yeah.
But the likelihood of longer term growth in Melbourne is higher than the Perth market, which is probably nearing the end of its growth curve. So when is the perfect time to buy?
Yeah, well, I mean, as you said, and I'm pretty sure there's sound bites of me on probably this podcast, let alone lots of other places, that at the end of the day, you should be buying something.
Yeah.
Right. You should be buying something because the minute that you're ready to buy is when you should be jumping in. But I think it's a bit of a wicked problem, right? Like it's some people will go one way, other people will go another, and the argument that we're having in our office at the moment around a few sort of markets like that is, you know, as a business, we have to, you know, we not only we have to, but we want to perform for our clients, right? And maybe it's the what's the word? Maybe it's the, I don't know, control freak inside me, or maybe it's the, you know, the person that just wants to always outperform expectations. The idea of investing into a certain market, which could have 2 or 3 years before it really starts to see performance, I don't know. A part of me just really doesn't like that, you know. But there's a really strong argument to be made as well, like you were saying, around if it is 4 or 5 years, and the scenario is you're not going to be able to buy. Like there is nothing you can do. So if you had a huge upswing in your property in the first 6, 12, 18 months, other than going and selling it, which probably wouldn't be that advisable in most circumstances, there's nothing you can do with it, you know? So it just sits there. Or do you go into that market that is underperforming, absolutely has, you know, a whole life of performance ahead of it. You can get the entire upswing of it, but you might wait 18 months, 2 years before you even start to see that performance. But you're not too concerned because you couldn't do anything with it anyway. So you just kind of have to sit back and go, oh, it's all good, you know. Probably get good cash flow, a little bit less competitive, probably get a bit of a sharper price on it because there's not as much competition, but you're playing a fractionally longer game, you know. And I think, unfortunately, people have a big recency bias. And I think that, yeah, you know, from a business point of view, and we don't probably talk too much about the business side of running a buyer's agency. We always talk about property and stuff. It's a real balancing act, because obviously if we were to do that for a client, we'd make that very clear to them. But the client then also has to understand there's a good reason why it happens, and that in 18 months, don't bang on my door and say you're unhappy, because it's going to come. It's just we played a long game here. So,
Yeah, that's the issue, because a lot of property investors now are being conditioned to this idea of
20% a year.
they're investing for the short term, and that's
Yeah.
okay if you're going to trade, right? If you're investing short term and you can trade,
Yeah.
Sell in and out of properties and redeploy their dough, very active investing, right? But the narrative of property investors have been conditioned this idea of like, you invest because you get immediate growth, but once you've got that growth, there's got to be sometimes a decade where you get very little growth. And everyone's absorbed and obsessed with Perth at the moment. Let's remember, Perth was in the doldrums for a decade. Prices only just got back to where they were probably in 2023 or something or other, right? So, property investors who bought at the wrong time in that market have held properties for a long time before they've seen any growth. So, again, it comes back to when is the perfect time to buy. So let's drill into it. And welcome back, Phil Tarrant from Smart Property Investment with Lachlan Vidler over at Atlas. How's your Pippa stuff going on, by the way? Property Investment Professionals Australia.
Yeah.
Getting busier?
It's great. I'm flying to Brisbane at the end of Feb, where we're doing our big planning day up there. So we're
cool.
Putting everything together for what we're going to do for all of our members. But it's good. It's good. I think it does great work. It really helps out keeping the industry honest. I think if you're working with a buyer's agent who's a member of Pippa, it's a really nice way to get a little bit of extra assurances that they're doing the right thing and they're not as far as you can guarantee anything, that they're there to do the right thing, ethics. So it's good. It's really good. It's really good. They do good work. The whole board of Pippa. Yeah. Volunteers.
Volunteers. Giving up their time.
Absolutely.
To help investors do
Absolutely.
better. That's good. So the perfect time to buy, Lachlan. You can always find reasons why not to invest. So people always think the market is, inverted commas, too risky. Therefore, it's not the right time to buy. And, every cycle has uncertainty. Here we are 5 years in from when it's really COVID was starting to make an impact as Australia. If you remember the GFC, there was that period of time when you got a lot of regulation from APRA around sort of shaping investment loan books, and therefore banks are penalising, and we've got every market's got some reason why you shouldn't do it, or the media will tell you otherwise. Why do people always think? Well, why do some people think the market's always too risky, and therefore it's never the right time to buy?
I think it's that people are afraid to take action. I mean, if you think about how many people out there are they're a gunner. I'm gonna start a business. I'm gonna get a promotion. I'm gonna move jobs. I'm gonna get fit. I'm gonna take a whole it's a lot of gunners, because it's hard to actually commit to something and taking action. So I think that for a lot of people, the easiest way is, oh no, this thing's just going on. So once this is over, then I'm gonna get through it, right? Once COVID's through, once these interest rates start to come down, once this happens, once I've done that, right? So I think that it's certainly not a dig at anybody. I think I think to an extent it's almost human nature, right? We all aspire to something greater than what we have at the present, but very few people take the steps to do that. And it's an easy way to sidestep it by talking about how there is some sort of uncertainty that exists right now, when that uncertainty can often be explained very logically and calmly to somebody who wants to hear that explanation. And then they can find a way through it to go, okay, well, cool, that makes sense. Let's rip in. Let's do it. Let's take action instead of sitting back.
Yeah. If you look back at past cycles, has there ever been the perfect time to buy a property?
Never. I mean, and I don't know. I don't want to put words in your mouth, but surely you would agree. There is never a perfect time. There is a perfect time, but there has never been a national perfect time. The perfect time has always been yesterday.
Yeah.
And then the second perfect time was always today. And then the worst time was always tomorrow. But I feel like at any point in history, there has always been something. Either it's been a recession, it's been a global health impact, it's been regulatory changes, it's been a weaker jobs market, it's been lower immigration. You can just run the list of things that you can always point to. But I think that if you look at anybody who's ever made money in property, they probably started 20 years ago, right? In a lot of circumstances. And then if you look at, maybe family or friends around you who have set themselves up for a above average retirement, a lot of them have probably done it with one or two properties in their belt, and they've owned them for time and time again. And I'm sure somebody will, you have those discussions and they'll sprout discussions around, it was 20% interest rates and I still did it. And, I knuckled down for the first 5 or 10 years of owning it just to try and pay it down. And at the end of the day, it's sacrifice.
Yeah.
And that's how you overcome an imperfect time to make it a perfect time.
I think if you ask me when was the perfect time to buy property, I would say the perfect time for me to buy property is when I started buying property. And
yesterday,
it's
right?
It's an individual thing. And you can only you can only look backwards for the perfect time rather than look forward. But when I started, I think there's a bit of luck in property. Like it's when you start rather than the perfect time, I think. So, I got all the benefits, and maybe through luck or chance, or maybe because I'm really shrewd, I started investing when Sydney had a massive run, which was sort of 2010-ish, 2011, 2012. And I was fortunate enough to start investing in the western suburbs of Sydney. That's just where I could afford at the time. But, I was lucky that that's the market that was hot at the time that I started investing. So, fortune favours the bold, but fortune also favours the prepared, So there was a certain element of luck that I was able to accelerate my investing journey as a result of that. Like, I didn't enter investing in the market when, say Perth was on a run. And I say I think they're going to be very different performing markets. I'd rather have Sydney-based assets long-term than Perth-based assets. But you can only look backwards at that and say, hey, that was the right time to buy is when I was ready to buy. And it's hard to argue.
I mean, I completely agree with you, but I think that even from your story, it kind of exemplifies exactly what we're saying. If you started in that late 2000s, early 2010s, it was still a time that excuses could be made about the GFC and how we're going, right? But you obviously didn't do that, and you took action. You talked about the fact that you feel really lucky because you took action in that time period. But there are other people who started their journey in 2020 when we had a huge national boom.
True.
That in 10 years' time, they'll say that I feel really lucky because I took action then.
At that point in time.
And I think that to me, the most important message that comes from your story is you need to take the action, because if you do, you will probably experience your version of luck at some point. But you can't do that until you take that risk.
No, and people think you're lucky. You're not really lucky. You're able to, you had to have a deposit. How did you create the deposit? You had to actually leverage that deposit into a house, but you needed to secure debt as a result of it. Well, the banks were happy to lend you money. So not a lot of luck there.
No.
A lot of hard work.
It's hard work. It's determination. It's preparedness. And none of those things happen overnight. Like, if you're in a job that allows you to save, to then have enough saved to buy a house, and maybe that means you need to save 80 grand. Well, I can guarantee that person's probably worked hard either studying or being out on the tools or something. It is a lifetime of preparation to put yourself there.
Yeah.
But people don't ever think about it that way.
So what's the real cost of waiting then, do you think?
Money.
Yeah.
That's the real cost of waiting.
And that's the reason why most people invest, correct?
Well, that's it. I mean, if you... we're talking before about, or I was talking before about how people have a recency bias, and you were sort of saying how investors these days have become very conditioned into going 20% growth is a norm, or, like you buy and it goes up immediately in 6 months or things like that. But if you strip it back and go property on average, depending on what where you read it, right? Like who's done the research or the data analysis on it. I've seen figures range from a bit over 5% all the way through to a bit over 7% as your annualized rate.
Long term.
Long term, yeah. Like if you take it
sort of
30
6
years.
point something or other.
Yeah.
Yeah, it depends.
So long term, we know that 20% or 15% or 10% or 30% is not actually realistic, right? So we then strip it back and go, okay, well, if say it was 5 or 6%, the cost of waiting is that money, because if you don't take that leap and it goes up by just the average, if you go buy a $600,000 property, that's 30 grand you might have lost.
Yeah.
Right? If you do better because you buy more intelligently or you get help or whatever it might be, that could be, you could make 10% or 15%. Suddenly you're now losing 60 to 90,000 through not taking action because I'm going to do it next year. I'm going to do it when the rates actually drop. I'm going to do it when the second rate drops, so I know that it's actually happening. I'm going to do it when my fixed interest rate expires, because even though I can't afford it, I just want to see something else, but that's going to be in a year and a half. You know, like we can fill the airwaves with every version.
Yeah, and one of the compounding aspects of this is that the real cost of waiting is you're going to miss out, right? But if you really mistime the time that you're waiting, you can really miss out, right? Like there's an amplification of that missing out. So, you know, if you look at, like, some markets are growing at 20, 30%, some of them are going backwards. But if you look at the long-term average, it's between 5 and 7%, right?
Yeah.
Every now and then you get moments in time where you get accelerated growth for whatever reason it is. And you know, the sort of post-pandemic period, there was an accelerated period of growth. If you miss out on little bits, like there's moments in times, and they say, like, if you invest in the stock market, you make most of your money, like there's a couple of times where you get all the growth, and the rest of the time it's pretty measured and mediocre.
Stability.
Yeah, it's a long-term time in the market. You're in the market when those periods of inflections grow. Same in property. So you can actually miss out. The amplification of missing out can be, you know, exacerbated tenfold if you're not there at that time. So you're better off being in the market. So this goes back to the original point. You know, are you better off being in a market that might not be growing now, but you actually get 100% of the upside when it actually moves?
Well, I mean, think about what happened with Sydney over the last, let's say, since 2020, right? And you were mentioning the boom and bust. I haven't actually read the new version of it yet. I've been meaning to do it. But I think you said that the base case was like a very small single-digit negative scenario for Sydney. I think that was what you
negative
said.
1%, maybe.
Negative 1%, yeah, okay.
I could probably find out. Yeah,
but I guess my point out of it is that if over the last 5 years, or even, let's say, over the last 3 years, so let's say over the last 3 years, your property went up 80%, and then last year, the fourth year, it went down 5% as a bit of a correction, and then this year it goes down 1%. You've gone up 80, you've dropped off 6, but if you weren't in it, you wouldn't have had any of it.
Wouldn't have had anything. And this is the point, right? Like, you get all the growth, you've got to expect some downside. Yeah, so the report here, and this on the base case of
what was it?
25 to 50 basis points cut in mid-2025, which is
by mid-2025?
In mid-2025.
Okay. Yeah.
Sydney's negative 5 to negative 1%.
Yeah.
However, so scenario 2 for Sydney was no rate cut in 2025, but and this is assuming 500,000 population growth and no new inflationary outbreak. So largely staying the same. So the only difference is there's no cut. Sydney to perform at -8 to -4.
So even with no cut, which we know is going to be happening, you're at worst case. Obviously, it's conjecture, but hypothetically, at worst case, -8.
Yeah, and then if there's a rate cut in the March quarter, so it's the quarter we're in right now, so +3 to +7.
Yeah. Okay. So there you go.
Yeah.
So,
and then if population growth falls to less than 400,000, so 100,000 less than those other cases, and there's no rate cut and commodity prices remain stable, so Sydney -10 to -6%. So population pressure will again shape growth.
As it always does. It impacts the demand side of an already limited supply equation.
So you see Perth is still looking at, on that base case, +14 to +19. Brizzy +9 to +14. Darwin +5 to +8. Melbourne -5 to -1 is the spread.
Yeah.
Adelaide +8 to +13. Solid performer. Hobart -3 to +2. And Canberra -6 to -2.
Yeah.
On that base case, which is 25 to 50 basis points cut in mid-2025. Anyway.
Yeah, well, it's interesting. I think it really goes to show. I mean, flip it. Like we like I said, we've been having some awesome valuations for our clients. From
where are the valves stacking up?
Honestly, like everywhere that we've been buying over the last few years. Like I was going to say, I got a good example of a client we bought for her. First deal was 2022, I think. I think 2020, probably around mid 22, and then maybe it was a bit later. It must have been end of 22 or start of 23. So we did a first deal for her, performed very, very well. Within about 6 months, it probably gone up about 100 grand. Within 12 months, it probably was up about 140, 150,000. She then naturally came back after having results like that. I think our fee for her was around like 14, 15K, make you 150 odd grand. Pretty good ROI on that one. So she came back, did a second deal with us, and that was 12 months ago because we got the valuation from the bank in like last week. And in 12 months, that property's up 150,000. We haven't had a new one done on her original one, but in the space of 2 to 3 years, done 2 deals for her, and she's made, probably starting to verge towards almost $400,000 in equty.
Yeah,
right? And that was because she just ripped in. She's not even Australian. She's European, and yet jumped in. Took action, jumped in. I mean, what you say if she pays 15K fees, 30 grand, make you 400, work out the ROI on that, insane, right? But I think
so happy.
Yeah, well, I think getting to what we're talking about, there's no such thing as a perfect time. Like she invested last year when inflation was still sky high. She invested towards the end, if not the start of that rate increasing. Sorry, the end of the rate cutting and the time when we thought it was going to stay on hold forever, or a bit closer towards where it started to go up. No such thing as a perfect time, but it was the perfect time for her. She jumped in, we helped, and look at what you can do, right? Just by taking the action, not being somebody who doesn't.
And this is the point back to, with turbulence, these things shall pass, right? You'll push through it and, investing through turbulent times. So, the market rewards action takers.
Yep.
So they've rewarded her.
Yep.
When there's uncertainty, turbulence, there's opportunity.
I think, is it Buffett's quote about the be greedy when others are fearful?
Yeah.
Is that Buffett that said that
I think
one?
so. Yeah.
The quote, be greedy when others are fearful and be fearful when others are greedy. We don't have to take it as literally as that. I mean, there's also some times when people are greedy and you can be greedy and it all works out. But ultimately, uncertainty tends to breed the biggest opportunity because it means that there's less demand in there, or a perceived less demand. And I would say, we've never had more clients coming on. We've never bought more properties. Like, there is still active people, and it has been for the last 12, 18 months. But on the whole, sentiment has been down. So therefore, less people who may have been willing to jump in have jumped in. But it's then translated into those that did have had that uncertainty, which has led to opportunity, which has meant, like this deal, 12 months, $150,000. And that wasn't $150,000 on a property that we bought for $900,000, so proportionately small. That was based off a deal that I think we bought it at $500,000.
Okay.
So, obviously the more expensive you go, 150 means less proportionately. It was significant. It was significant. So...
And when you get uncertainty, you get different market dynamics as well, where you may be able to pick up undervalued properties, or you may be able to take advantage of sort of vendor discounting because, there isn't the same. You want to be targeting more buyers markets rather than sellers markets, and that typically takes place when there's change, when there's turbulence, when there's discussion around interest cuts. So, so people can actually operate tactically and smartly in this environment.
Yeah, and I think it really then starts to get into the nuance of where are you at in your portfolio? Have you started? Have you not? Are you? What's the next thing that you're adding in? What does your portfolio plan look like? Do you even have a portfolio plan? Because if not, you're going to need somebody to help create one for you. But depending on all those different elements, you can take advantage. And it was kind of like what we were talking about before for our current office discussion, being in certain markets that maybe you don't need it to go up in the next 18 months because you might not need to use it in the next 18 months. Or you might be in a job right now that either you don't want to stay in or the money isn't going to last. So you need to have really rapid growth to then continue leapfrogging into subsequent properties over the next 2 to 3 years. So you need to make sure that you're in areas that are going to have really good injections of growth now. So I think it really comes down to where are you at and then taking advantage of those dynamics when they're at play, because if there's one thing I can say is if you think that people haven't been that active over the last 6 to 12 months and you've even mildly looked at trying to buy in property and you've found it challenging because there actually has been some demand, what do you think is going to happen when rates actually cut?
Yeah, and that's a really good point because it's a mindset and a sentiment shift, and we should probably address that. But buying in a buyer's market, a seller's market, when there's less buyers in a market, typically you've got greater propensity for maybe securing bargains or getting stuff under market value. As we enter an interest rate cutting cycle, that will have a massive shift to sentiment with Australians. So even though you pass on 25 basis points on a $1 million mortgage is $2,500 a year, right?
Yeah,
right. It's a fair bit of money, but you sort of pull that out over
it's not a ton.
It's not a ton. Like it really, it's what is that, $50 a week or something or other, right? Like, is my math right on that? Would be about that? Yeah, maybe.
Five,
25. Yeah, close enough.
Yeah.
Like it's not really that much, and that's if you've got $1 million worth of debt. So, everyone's sort of wed to this idea of like things are going to get cheaper. So you get that's 25 basis points. So if you get a 4 percentage point cut on $1 million each year is $10,000. Like that's sort of meaningful.
That starts to add up. Yeah,
it's fucking meaningful. What's that? 8,000 odd bucks a month, right? Is that 800 odd bucks a month. Sorry. It starts getting meaningful, but it's not going to change the world for most people. So we're chatting about the market rewards action takers, but the consequence is this fear of making the wrong decision can stifle people's attitude towards it. Like, yes, there's going to be more buyers in the market, therefore I'm not going to get the same deals I could have got yesterday. So therefore I won't do anything.
Yeah. And I think that at the end of the day, property is a long-term asset. So to be in something long-term, you have to be in it to start with. Yeah. And that clock doesn't start ticking until you buy it. So, I mean, think about all the people who sat back in 2020. And I'm seeing it now. People that I spoke to professionally back in 2020 who did nothing for whatever their reason may have been, or 2021, are now coming back and saying, like, we really nothing other than we regret not doing something. Like, we have missed out on all of this. We could have.
Do you refrain from saying, "I told you so"?
No, you know what? I lean into it. I say, "You're an idiot." I tell them, because at the end of the day, my job isn't to mince words. I don't need to be a dick about it. But for me, the important thing is to make people realize, especially when they've already come to a lot of that realization themselves, to ram it home. Don't make that same mistake.
Yeah,
And I'm really grateful that you're here talking to me now and you've maybe recognized that. But let's not now let fear overcome you.
Yeah,
it's or you're going to repeat the same mistakes.
Which happens all the time. People repeat and they forget, and they'll be like, "What if the market crashes?" Well, the likelihood of real estate market crashing, inverted commas, like let's look back through history. Recent history, you're supposed to get a 40% reduction in prices during COVID. That's what the bank economist told us. It didn't happen. GFC didn't happen. Structurally, structurally, we don't have enough houses in Australia to house the population we have right now.
Quite literally, structurally.
And the government is highly invested in real estate, and the banks are highly invested in real estate because they, so the likelihood of the market crashing is low, but. A lot of people are going, what if interest rates go up again? Well, here's a news flash. Interest rates will go up again.
Yeah, at some point.
Yeah.
In history, in the future, it will go up.
Yeah. They're gonna come down.
Yeah.
And they're gonna go back up.
Yep.
Guaranteed. Yeah. I can guarantee that right now. If we get interest rate reductions, they will go up again.
Yep. And
I don't know when, but they will.
Yeah. And I think this is the thing. We obviously also have the Pathway to Property podcast that we do.
You can listen to that on the Property Investment Podcast Network.
Yep, absolutely. And we're getting a great response, so big shout out. Thanks everyone. It's been awesome.
Cool, great.
But I believe it was something I spoke about on there very recently, which was that you can't control that. It could go up, it could go down, it could go sideways for the next decade. You can't control that. No. So what can you control? You can control, am I going to make a decision to invest? Am I going to save an extra bit of money, or am I going to go and buy the new car or the extra holiday or whatever it is? Am I going to try and educate myself to set myself up to be better prepared for when I am in a position, because right now I don't have enough money? You can change and impact those decisions. But you, as an individual, cannot change whether inflation is embedded in the economy.
I would say there is one way you can change it.
How's that?
Everyone gets to have a vote at some point in time.
That is very true.
And inflation, the economy, all that sort of stuff will be dictated and determined to some degree by who's in power in Australia.
Yep.
But again, like the Australian government's making its decisions without being able to control what happens globally, right? So there's a little bit, but you know, you get that vote.
I like where you went with that.
It's the masses.
Yeah.
The masses can choose who they want sort of with their hand on the tiller of the Australian economy, right? We get to have that chance in
absolutely
a couple of months' time.
Well,
right?
and I mean,
but back to your point, that's outside of that, you can't do anything about it.
Absolutely. And I think that as soon as you get comfortable with the idea that you cannot control that, the better your life is going to be when it comes to property investing.
Yeah.
Because then you're going to realize that if you look back in history, there have been plenty of upturns, there have been plenty of downturns, there have been plenty of periods, which is the vast majority, which is where it's neither an upturn nor a downturn. It is just life carrying on. And yet those are the times when people end up feeling the best about things because they don't have really high levels of euphoria. They don't have any sort of deep depression feelings because they're going, oh no, I was stressed about this. They're going, oh cool, I own a property. I own 2 or 3 properties, and I don't even think about it. I'm just carrying on with every other part of my life because things are just run of the mill.
Just run of the mill. But so you can take action. You can take action today. So theoretically, it's really nice to chat through all these things around. What happens if you don't take action? If you do take action. The fear of missing out, what is the consequence of mistiming, all this sort of stuff. So I think the conclusion is buy property when you can buy property.
Yeah.
But then you've got to get into the nitty gritty of what, where, when, how, right? So how do you actually take action? Let's talk about this. Sort of probably 5 main areas, and we'll conclude with this podcast on this episode. So you probably start with knowing where you're at financially, right?
Absolutely. You can't begin to look at investing if you don't know where you sit. And let's call a spade a spade. The whole point and the whole reason I want to talk about this today is because sentiment is already shifting. Markets have already performed for the last 12 months when the media says it hasn't. It's only going to get substantially worse in the sense of if you aren't in it, what you're missing out on, and better if you are invested or you're about to invest on what you're going to see. But the longer that goes, the more people who are ill-informed and throwing money at deals and things like that are going to come into the market and make it harder. So by not taking action today and looking at what you need to do and what we're going to go through, you are setting yourself up to be looking back in another 2 years and saying, I didn't do it in 2020 during COVID. I didn't do it 5 or 10 years before that anyway. I didn't do it in 22, 23 when I'd seen that the world didn't, cave in. And I didn't do it in 25 when I saw that rates were dropping and that we already have a critical shortage of properties. And yet I somehow thought the market was going to crash. I'm an idiot, right? So as you said, you got to understand that financial position because then you know how much you have in savings, something that, people don't realize. You might have equity in your own home. You don't need to have saved. You can invest with no money down in a hypothetical sense, right? But you need to know where you're at. And if you don't know how to do that, you need to speak to someone, right? So for example, you come and talk to me and my team at Atlas, and we can help you and put you in touch with people that can help you to understand how that financial position sits for can you borrow, how much can you borrow, how much might you look to buy for, things of that nature. So you've got to understand that financial position to start with.
Okay. So you probably need to know where you sit financially. So speak to a good broker.
Yeah, exactly right.
Yeah.
But a good broker, not just a broker.
Yeah, an investment savvy mortgage
An
broker.
investment savvy, very aware, experienced broker, not one that says, oh yeah, I can write your loan. That's no issue.
Yeah,
That's
yeah.
fine.
And not all brokers are created equal in this regard. You want someone who's used to and capable in working with investors that particularly, if you're looking for building a sort of a wider portfolio, it's important you get the building blocks right at the front end. So a mortgage broker can help you get pre-approved. That's where you can take action.
Yeah.
Probably the big first step, right?
Massive, right? Like I got a good story. No names on this one, but we have a client come to us, brought their own mortgage broker, which is fine. A lot of our clients want us to put them in touch with people that we work with because they then know that they're good at what they do. But then we still have, I reckon, probably 25, 30% of clients that come with an existing relationship, right? This client, we didn't know, but it turns out that they're going to buy under a trust company structure. So already it is even just fractionally more complicated. Even if they have good financials, it's still just fractionally more complicated than a vanilla personal name home loan deal, right? And the broker came back and said, sorry, the client came back to us and said, oh, my broker doesn't do pre-approvals. And I said, okay, well, that's interesting. Usually we find that that's mainly because brokers that don't do it are lazy and they just don't want to put time into something that they don't know is going to mature into an actual deal. And we said to the client, look, we should go back and just say the reason we want it is because A, you've already got a tight enough budget. We want to make sure the bank has actually assessed you and actually said we're comfortable in this moment today to give you that money. And then secondly, because you are buying under a trust and company setup, there's no issue with that, but it's still just fractionally more complicated than going, here's my PAYG pay slip I'm buying in the name of Lachlan Vidler and that's it, right? This broker comes back, fires up over email and basically tells us to stick it and says, you know, they know better than us and they've never seen issues and this and that and that it's not harder. And we said, we're not saying that there's an issue with buying under a trust, just that any good broker that we've worked with, and we've probably worked with 200 or 300 of them, has never put up such a fuss about doing a pre-approval. And the last thing we want is for our client to not get approved when they're now emotionally invested in a deal, all because you just didn't want to do a little bit of extra paperwork.
Yeah.
So anyway, bit of a story for it. But the point is to get that pre-approval, because if your budget is tight or you're buying under different structures or, you know, it's your first time and you're a bit nervous, you want to make sure that the person that's giving you the money has looked at you. And if you do have issues, which a lot of people do, like it might be an Afterpay account you didn't realize you had open. It might be something that doesn't even come up that you declare on the form because you've just forgotten about it.
Yeah.
You deal with that before you jump into buying, because when a deal is in place, even if you've got a finance clause, if you've only got 7 days or 14 days to sort something, you don't want to be in that stressful position of going, my God, I only have a short period to fix this. I wish I had just known about it before we even started actively looking.
Yeah, and it's easy to mitigate. And it's a bit strange broker not want to do pre-approval.
Laziness, pure laziness.
Just I can't be bothered doing it. Yeah.
Had a massive...
But the thing is, all the work's already done at the front end. If the buyer's serious, and as a mortgage broker, you know whether or not the buyer's serious or not. Yeah. You can do an assessment and see whether or not they get a loan pretty easy. You go, yeah, put the work in.
Yeah.
Put the work in, broker.
Yeah.
You know,
and
don't be lazy.
They've paid us. Like, this isn't like it's somebody off the street. Firstly, this broker had also worked with this client before. So they knew that they would pull triggers on deals. And then they also know that where they've paid us as the buyer's agent to do it, the deal is going to happen, you know? So, yeah, to me, sheer laziness. And probably the worst part was they were just rude. Like, one of my staff was emailing and just came back, just cracked at my staff. And I don't tolerate that.
That's
like,
not cool.
It's not cool. And I said, you know, this is our client. It's not your client. It's our client. We're together. We're not on opposite sides here. We're working for the same outcome, which is the client.
You need your partners working well together. And if you choose to use a buyer's agent, you've got to, you want to have them really tight relationship with your accountant and also your mortgage broker, because that's the only way you get great outcomes. But you've actually got to go out, like, you get yourself a pre-approval. You've got to take action, right? And taking action is actually buying something. And you know, in principle, you want to find something where there's value, right? Upside value, or it's undervalued or is upside value. Using a buyer's agent, for many people that tune into this podcast, probably, what they do. But, if you don't use a buyer's agent, you've got to do the role of the buyer's agent. And that's doing all the research yourself. In markets that are changing, it's often hard to quantify what, in inverted commas, an investment grade property is, and that's really what you want to be finding.
I could not agree more. I think, like, you don't have to use a buyer's agent. Like, you don't have to come and talk to me in Atlas. You don't have to go and talk to any of the other good buyer's agents that come on the property investment network. You don't have to do that. You can do it yourself, but can you do it yourself well? Right? Like, I can go and try and stitch up the cut on my hand, but am I going to do a good job of it? Probably not. I am not a doctor, right? So if you feel as though you've got a background or you've got the skills or the experience to do it yourself, go and do it yourself, right? You don't have to deal with other people. You don't have to go and have stress about thinking, is this person going to work well for me, even if they've got 5-star reviews and all this sort of stuff. Do it yourself, right? But like you said, you're going to have to put the work in. Like, do you have the time to put in 100, 150 hours in a time period that's condensed enough that the information and research that you undertake at the start of that 100 to 150 hours is still relevant at the end of it, or is it now 12 months later and you've got to restart because it wasn't fast enough? So you have to, like, the deal is made when you buy. And that starts with where you're going to invest, and then moves to what you're going to invest in. So if you're not confident in that, shameless plug, come and talk to me and the team at Atlas, right? We're pretty damn good at what we do.
Well, that's what you do.
You know, like, do you want to be part of that, like that client, 350, 400K equity for a 15 to 30K investment in us over a number of years? I would say good ROI.
That's not a bad return. It's not a bad return on
Not a
investment.
bad.
But I think also is that outside of just, and again, it's buyers agents in many ways now have been framed within a very small part of what they do, and that is actually finding the asset. There's a whole bunch of other stuff they can help you with. And one of those things is accountability, right? And the best buyers agents I know keep their clients accountable to a plan. And you talk about planning, smart plans, SMART.
Smart plans.
Smart planning, specific, measurable, actionable,
realistic,
and time bound too.
Yes.
So the key part is that T. Like the accountability is the time, the speed to move, because I think we've spoken about what happens if you don't at all. But the sooner you make a decision based on the fact that you're buying value or investment grade assets, the faster you want to do it. So you actually need a deadline to make the move, and sometimes people need help with that.
I can't tell you the amount of stories of us speaking to a potential client, and then that potential client, we finish up the conversations that we have before somebody signs on to work with us, and it basically gets ended in a position of, I need you to come back to me in a couple of months for whatever reason it is, right? Maybe they're selling their house, maybe they've got to save an extra couple of dollars, maybe it's really busy at work, and I need to get through this. I promise I'm not blowing you off. I need to get through this. Call me again in a month or 2 months, and then we do it, and we can't even get them on the phone. Yeah. And then you sit back and you just go, I'm just sad because I know what you're missing out on. So having those time frames set on when you're going to take action and then actually sticking to it is by far the most important thing. Yeah. And the story I've got about somebody who has actually done it, and like, this guy is like a dog with a bone. I spoke to this bloke. I don't know if he actually listens. Maybe he does. He's a Brazilian bloke, and he reached out to me, I think in 2020 or start of 21. Yeah. Did not have enough money. I think he had about 40, 50K at that point. And I said at that point, because of where property prices were, I think I said, you need probably minimum 65, 70. So he goes away, and I get a message from him probably 18 months later. So it must have been like towards the end of 22 probably at that point. And he goes, oh, hi, I'm almost there. I've gone from my 40, 50K. I'm now up to around like 60, 65. And I said, oh, mate, I'm so sorry. But like the market's moved. Like we're now talking 18 months later. All this has happened. You now need, whatever the amount was at that point in time. And he goes, okay, all right, that's all right. He comes back. He goes away. He hits me up again, I think at the end of 23, start of 24, and he's reached it again. But it was the same story. It was, man, I'm so sorry. It's just, I can see you putting in the work, but unfortunately, like, you're going slower than the market's moving. Yeah. But keep your head down because you are doing good things, right? Do not let it discourage you. Anyway, he messaged me again about 2 weeks ago, and he said, I'm up to this number. Yeah. I've gone past what you said because of what's happened the last few times. And lo and behold, I think we can actually finally help the guy.
Cool.
But
good on him.
He set some actions. He set a time frame. He kept meeting it, but unfortunately, circumstances happened outside his control. But I don't know if I've ever seen anybody have such dedication.
But you need to have it. Like, and this is what they say is all that's wrong with property at the moment, because people are just perpetually saving, but they're saving at a rate which is slower than the speed of the market. Yeah. So something structurally needs to change. Yeah. Yeah. Something structurally needs to change. And it's even more challenging for owner-occupiers, at least with if you're buying investment products. You can always sort of find something within your range, just whether or not it's a good location to invest, right? So this is where it's gets challenging. So, it's good that you've helped him stay accountable, but he stayed accountable to himself. So
it's honestly mind blowing. I really we're still just I think we've got to have one more meeting with the guy, but I really hope one of my teams.
You better find him somewhere good now.
Yeah, it's just, but you know what? Like, it's actually those sorts of things that makes me really happy about what I do, because I know that even getting one property for this guy, even if it is not the biggest all-star performer, but considering it's taken him 4 to 5 years to save up the better part of $100,000. Yeah. He started with 40, 50, so the better part of 50, 60 grand. Yeah. I know that even if in 2 years we got him 50 grand, which would be a very big underperformance on what our standards usually are. That is already fundamentally changing the way his life is going to go.
And this is the point. Like, you got to, like, the sooner you start.
Yeah.
And this is prefacing on the basis that you're buying good properties, right?
Yeah.
You know, starting into with crap properties doesn't make any sense at all. But I'd like to think people that tune in this podcast don't do that.
Yeah.
Just starting the amplification effect of that deposit in the market.
Yeah.
Is going to outpace any ability to save money.
Yeah.
And often it gets to a point where it outpaces people's, you know, it's just, typically when you're new to investing, one of the first things you're saying is that I just made the same amount of money in capital growth this year than what I did with my full-time job.
Yeah. It's crazy, isn't it?
Tax-free.
It's crazy.
You know, and that's unrealized, you know, capital growth, right? But that's typically you see it all the time. People just go, hang on a sec. So I just made the same amount of money. I just doubled my salary without having to do the work.
Yeah.
You know, that's typically a first little, you know, frame of reference or perspective for people. And no doubt, hopefully this gentleman gets that. This bloke, this Brazilian bloke. I don't know if such thing as a Brazilian bloke, is there?
But I think you're so on the money there, because at the end of the day, the cold hard truth is literally probably, you know, the odds of even a single listener of this show even coming close to being a billionaire is probably not going to happen. So if you can retire 10 or 15 years earlier than you would have if you had have just tried to save your way there, or, you know, just run the regular life and not invest in even just 2 or 3 properties over your whole working life, that is already fundamentally changing the trajectory of your life and your retirement compared to what it would have been. And, you know, almost none of us are ever going to be, you know, a Mark Zuckerberg or whatever. And trying to chase the $1 billion is just silly, you know, like life, if it's 10 or 15 years earlier and better quality.
And this is perspective,
you know,
in property investment, because, again, I think the narrative has been pushed away that property investors become billionaires, right? They don't.
Yeah.
Right? You know, the outcome for most Australian investors, and I'm sorry if this sort of, you know, puts a bubble in your balloon, is 2, maybe 3 properties. That's the perspective that you need to be framing. You know, maybe 4 to 5, frame of reference. But if you've got 4 to 5 investment properties, you're
killing it.
You know,
you're in the top 1%.
It's crazy, right? I think, and if you got over, I think there's only maybe the numbers always change. 30,000 Australians that have more than 6 properties, I believe. Right?
Yeah, it's about that.
It's so you've got to put things into perspective.
Yeah.
You're doing well just by getting 1 investment property.
For sure.
You know, if you get 2, you're doing extremely well. So, you know, the key thing around that is that people who are actually able to make the action takers, decision makers, are those people who can block out the noise.
Yeah.
You know, and it's tough to do that sometimes, because there'll be all the reasons why outside of your head or internally in your head, all the reasons why things are bad, all the reasons why you shouldn't do something, all the reasons why it's not the right time, all the reasons why everything's going wrong.
Yeah.
When typically it's not.
Yeah. And I think it's a short and sweet point. The media is paid for one thing, and that's to create eyeballs and move the eyeballs and things like that. You have to block that stuff out. You have to listen to the smart, intellectual, and industry-based stuff, like, for example, this podcast or other property podcasts. And, of course, everybody has an agenda, right? I run a business. I definitely want to help more people and clients, and I do it because I love it. But of course, we also make money. Like, we don't need to pretend that part doesn't exist. But I also have a reputation, you know, and I'm not going to come on and talk about things that I don't feel are true, and other people in the industry are the same. So, do you trust a journalist that also covers, you know, like the local school getting robbed, as well as trying to write a sophisticated property investment headline?
Here's a hot tip. Most journos are left-leaning, and most journos probably don't like the idea of people making money through property because they feel as though it's shouldn't be it shouldn't be an investment, right? Like, and that's what you're getting, right? But, you know, to your point, like, if you're using a buyer's agent, you need to have an appreciation for what a buyer's agent does. You can do all that yourself. You can do that. But what will probably happen is what we've spoken about today. You'll never take action. You'll find all the reasons why you shouldn't be doing something. So it's a exchange of value for speed to maneuver.
Absolutely. And
it's okay. You want your buyer's agent to actually be good at what they're doing, and therefore they make money. Like, let's be clear.
Yeah.
You don't want a bad buyer's agent who's
Absolutely.
not making money. You want a good buyer's agent who provides quality service to people, or do it yourself,
Yep, exactly right.
or do both.
Yeah.
It doesn't matter.
I couldn't agree more.
Yeah.
I couldn't agree more.
All right, Lachlan, we've written the rights and wrongs of the world today. Good
As
to come
always.
in. As we fly through turbulent times.
Yes.
It's so a big year ahead for you. Then there's no more holidays.
Massive
Yeah.
year. No, I'm trying to make sure that we have some sustainability of practice as we go through. I think working myself to the bone, as I always do, is not going to be what's best for the clients or my staff for this year. So I'm going to probably try and take one or two, little breaks throughout the year just to keep sharp. But we got big things brewing. So, for anyone who's really, listening to this and wants to take that action, come and have a chat with myself and the team.
Good.
You can find us at atlaspropertygroup.com.au. Just drop in an inquiry there. Come and have a chat. But I think if I can finish on one thing, we've actually just launched a really exciting new service for people.
Here we go. He told me he was here not to sell anything.
I'm here to sell this one, all right?
Yeah.
We've just started a portfolio review service. Okay. So what we're doing, because we've got access to data that most people don't, and obviously we've also got our experience and expertise. We have a lot of clients who want to get a bit of a health check on their portfolio, and just having someone cast the eyes over, this is what that number looks like. Oh yeah, she looks all right. Yep, all good. Should be right. The classic Australian attitude.
No worries.
We're taking it a much more sophisticated approach. So we've launched a portfolio review service, if you want to call it that, and it's designed. People that have say 2 or more properties will get the most value. If you have 1, we can obviously still do that as well. But it's designed for those people with a few more properties. They really want someone to have a look at, the market that those properties are in, a few of the numbers on the property, try and get some real actionable insights out of it as well to see where, you might need to go next. And we've had some great feedback. We launched it with our partners. We've launched it out to our email database yesterday.
Okay.
So I put it out to the SPI guys and girls, the listeners. If you go to our website, atlaspropertygroup.com.au/portfolio review, there's a little inquiry form there.
Portfolio dash review or just
portfolio review?
Okay.
Nice and easy, no dashes.
Yeah.
And you can drop an inquiry in. We haven't updated the website for it to be on the bar at the top, so you got to put in the URL.
Yeah.
You can come and there is a fee for service, and it obviously depends on how many properties you have there. But
So you're charging people for this?
We are, because of the depth of research. So for example, if you got say 3 properties and and we do that review, you're going to get a document of probably about 25 pages back about that. So unfortunately, we're putting too much into it to do it for free. But we're giving that insight.
I fundamentally think that's a good idea.
Yep.
You've got to pay for advice.
Yep.
If I go to a financial planner, I expect to pay for financial advice. If I'm going to get someone to give me considered
property advice,
I'd expect to pay. If you're not paying for it,
you got to question how valuable it really is, right? So it's might only be a few $100 depending on where you sit, or probably not a few hundred, but in the hundreds of dollars range. We're not talking about $10,000 or anything like that. And then obviously the more properties, the price goes up and everything. Okay. So I guess think of it as an investment rather than price. But,
it would be a tax deduction as well.
See a good accountant for that.
No, it would be if it's for the purpose of your property portfolio. Yeah. I'm sure it's tax deductible. I would imagine it is. Yeah. Just like getting advice. So and again, you want to make sure that your property advisory people are trained financially, sort of legitimate advisors, right? You got to look for the look for the qualifications.
Yeah, absolutely. Well, I mean, I can say, for example, on our team, my finance master's background, one of my team has an accounting background. We've got other people with different sorts of qualifications in the same realm. Of course, none of it is financial advice. It's all centered around property advice. However,
but Pippa has a qualification, doesn't it?
They do. Yes.
Yeah.
Yep.
QPIA.
Yep. Yeah. So. Yeah, if you're interested, come and have a chat. We'd love to review, see where you're at, see if we can add some value in there, even if it's just something as small as, another professional that we recommend you see to help with something or whatever it might be. And then maybe we can also help you keep growing that portfolio.
Well, that's the idea. At a point in time, you want to stop, but you want to keep growing.
Absolutely.
So that's what I'm thinking at the moment. But Lachlan, thanks for coming in, mate. It's always
Thanks
good
for
to see
having
you.
me.
First podcast for the year.
First one.
You're a semi-regular guest, so we look forward to seeing you on here again. I think we've probably got a few sort of set aside for the coming year. So enjoy the conversations. Always good to see you around the traps as well.
Absolutely.
And what's the website again?
atlaspropertygroup.com.au. So jump on there. You can see us in general and book a call in terms of growing your portfolio, or that review, atlaspropertygroup.com.au/portfolio review. All is one word.
Brilliant. All right. Thanks for coming in. Thanks for tuning in, everyone. Remember all the social media stuff and those, what do you call them, reviews and stuff on wherever you tune into this. The team get a real kick out of it. It's good to see. The more you do of that, the wider we can make this community. So hopefully we can help make more informed investors who can take decisions to help them on their pathway of wealth creation. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.